The intelligent investor, often hailed as the Bible of value investing, provides a framework for developing a stable, disciplined approach to investing. Benjamin Graham introduces foundational investment principles, focusing on minimizing risks, valuing securities, and ignoring short-term market fluctuations. His teachings are based on conservative, long-term wealth-building strategies, and he emphasizes the importance of emotional discipline. Detailed breakdown of key concepts and strategies. 1. Investment versus speculation. Investment. Graham defines investing as a careful analysis of securities, prioritizing safety and adequate returns. Investment decisions should be based on a thorough understanding of a company's fundamentals, including its financial health, revenue stability, and earnings growth potential. Speculation. Speculators, on the other hand, focus on short-term price movements rather than intrinsic value. Graham warns that speculating often leads to high risks and potential losses, especially for inexperienced investors. He emphasizes that those aiming to build long-term wealth should avoid speculative strategies. 2. Types of investors. The defensive and enterprising investor. Defensive investor. This type of investor values safety and stability, aiming to minimize risk through conservative investments. Graham recommends a diversified portfolio consisting mainly of high-grade bonds and well-established, dividend-paying stocks. The defensive investor should avoid frequent trading and focus on maintaining a balanced portfolio with predictable returns. Enterprising investor. This investor is willing to dedicate time and research to uncover potentially undervalued stocks. Enterprising investors seek overlooked or unpopular stocks, often in sectors with low public interest, where bargains may exist. While this approach can yield higher returns, it requires diligence, patience, and a deep understanding of market fundamentals. 3. The Mr. Market analogy. Graham introduces Mr. Market as a metaphor for the stock market's often irrational behavior. Mr. Market's emotions swing daily between optimism and pessimism, leading to fluctuating stock prices that may not reflect a company's true value. Instead of reacting to Mr. Market's erratic moods, Graham advises investors to use them to their advantage by buying undervalued stocks during pessimistic periods and selling overvalued stocks during optimistic phases. Viewing the market as a partner rather than a guide, Graham argues, allows investors to make better, more rational decisions. 4. The margin of safety principle. One of Graham's core concepts, the margin of safety, involves purchasing securities well below their intrinsic value to protect against unexpected drops in stock price. For instance, if a stock's intrinsic value is $50 per share, an investor might wait until the stock is priced at $30 to buy, creating a buffer or margin that reduces the risk of loss. This approach minimizes the impact of potential errors in judgment or unforeseen market changes, helping preserve capital. Graham considers the margin of safety principle essential for both defensive and enterprising investors, as it adds a layer of security to any investment. 5. Intrinsic value and fundamental analysis. Intrinsic value. This refers to the true worth of a stock based on its fundamental data, such as assets, earnings, and dividends. Graham emphasizes the importance of calculating intrinsic value to distinguish between undervalued and overvalued securities. Fundamental analysis. Graham encourages investors to analyze a company's financial statements, focusing on aspects like revenue stability, earnings growth, and debt levels. By understanding these elements, investors can determine a company's true value, helping them make informed decisions. 6. Balancing stocks and bonds. Graham advocates a balanced portfolio comprising both stocks and bonds to mitigate risk. He suggests that a portfolio should ideally be divided 50-50 between stocks and bonds, though adjustments can be made based on market conditions. Bonds add stability, especially during economic downturns, while stocks provide growth potential. This balance between income-generating bonds and growth-oriented stocks creates a foundation that can weather market volatility. 7. Dollar cost averaging. Graham recommends dollar cost averaging as a disciplined investment strategy. This approach involves investing a fixed amount regularly, regardless of stock price fluctuations, thus avoiding the temptation to time the market. By investing consistently, investors buy more shares when prices are low and fewer shares when prices are high, which reduces the impact of volatility and leads to a lower average purchase price over time. 8. Avoiding common pitfalls and psychological traps. Following market trends. Graham cautions against following market trends or popular opinion, as these often lead to herd behavior and inflated stock prices. Instead, he advises sticking to rational analysis and personal investment principles. Short-term market movements. Reacting to daily price changes can lead to impulsive decisions. Graham advocates for a long-term perspective, focusing on a stock's intrinsic value rather than short-term market sentiment. Emotional investing. Emotional responses to market news can lead to poor investment choices. Graham emphasizes the importance of maintaining discipline and not letting fear or greed dictate decisions. Guidelines for stock selection criteria for defensive stock selection. Large, stable companies. Defensive investors should choose established companies with a proven track record of stability, moderate growth, and predictable earnings. Low debt. Look for companies with low debt levels relative to their assets, as high debt increases risk. Consistent dividends. Select companies that pay regular dividends, as dividends provide a steady income and indicate financial health. Reasonable price to earnings, PE, ratio. Avoid stocks with excessively high PE ratios, as they may be overvalued. Graham suggests looking for companies with PE ratios below the industry average. Guidelines for enterprising stock selection. Seek undervalued stocks. Enterprising investors should focus on companies whose market prices are below their intrinsic value. Analyze financial health. Look for companies with solid earnings, low debt, and favorable profit margins. Avoid highly popular stocks. Stocks that receive a lot of attention tend to be overvalued. Enterprising investors often find better opportunities in overlooked or underappreciated sectors. Use financial ratios. Graham recommends examining ratios like price to book, PB, price to earnings, PE, and debt to equity to assess value. Practical lessons and modern relevance. Long-term focus and patience. Graham's approach to investing requires patience, as real wealth building takes time. He cautions against impulsive decisions based on short-term market news and advocates for staying committed to one's investment plan over the long term. Risk management and diversification. Graham stresses the importance of managing risk through diversification. By spreading investments across different sectors and asset types, investors can minimize potential losses. His margin of safety principle also plays a key role in risk management, providing a buffer that protects against market volatility and errors in judgment. Importance of financial knowledge. Graham emphasizes that successful investing is based on knowledge and rational thinking, not luck or insider information. Educating oneself on fundamental analysis, intrinsic value, and market behavior is essential for intelligent investing. The relevance of Graham's principles today. Despite changes in the financial landscape, Graham's principles remain relevant. The core ideas of value investing, such as buying undervalued assets, maintaining a margin of safety, and ignoring market hype, continue to guide successful investors today. Conclusion. The intelligent investor provides a timeless blueprint for building long-term wealth with a disciplined, value-focused strategy. Graham's philosophy centers on avoiding speculative behaviors, focusing on fundamentals, and controlling emotional responses to market fluctuations. His insights empower investors to achieve stable financial growth while managing risk effectively, making this book a cornerstone for anyone serious about financial independence and investment success.